Hi everyone, welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge etc. Today I will discuss about group discussion topics related to the internal promotion examination for banks. Welcome to part 20 of my Path to the Corner Office 2025-2026 series where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Today's group discussion topic: credit growth versus credit quality, finding the right balance. Introduction: credit is the lifeblood of the banking system and a key driver of economic growth. For banks, especially in a developing economy like India, achieving strong credit growth is essential to support industries, infrastructure, MSMEs, agriculture, and retail consumption. However, aggressive credit expansion without adequate risk assessment can compromise credit quality, leading to rising NPAs, capital erosion, and systemic stress. Hence, the real challenge before banks is not choosing between credit growth and credit quality, but finding the right balance between the two to ensure sustainable profitability and financial stability. Understanding credit growth. Credit growth refers to the expansion of a bank's loan book over time. It is often viewed as a sign of business expansion, market penetration, and economic momentum. Importance of credit growth drives economic development and employment, enhances interest income and profitability, improves market share and competitiveness, supports government initiatives like MSME financing, infrastructure development, and financial inclusion, essential for achieving targets under private sector lending (PSL). Pressure points for banks: annual business targets, competition from private banks, NBFCs, and fintechs, expectations of shareholders and governments in PSBs, economic recovery phases demanding higher credit flow. Understanding credit quality. Credit quality refers to the likelihood of timely repayment of loans and the overall health of the loan portfolio. It is measured through indicators such as GNPA, NNPA, slippage ratio, SMA levels, and provision coverage ratio (PCR). Importance of credit quality: protects bank capital and profitability, ensures long-term sustainability, maintains depositor and investor confidence, reduces provisioning burden, supports better credit ratings and lower cost of funds. Key drivers of good credit quality: robust credit appraisal and due diligence, strong risk management systems, early warning signal monitoring, effective post-disbursement supervision, sound recovery and resolution mechanisms. The fourth dilemma: growth versus quality. The conflict arises because faster credit growth often involves higher risk segments. Conservative lending may protect quality but slow growth. Economic slowdown demand credit supports despite higher risks. Overemphasis on growth can lead to asset quality deterioration. Excessive focus on quality may result in missed business opportunities. Historically, India has witnessed phases where excessive credit growth, that is pre-2008 and 2010 to 2014 infrastructure boom, led to a sharp rise in NPAs later, teaching banks the cost of ignoring credit quality. Arguments in favor of credit growth. Economic imperative. Without adequate credit, GDP growth suffers. Counter-cyclical role. Banks must lend during downturns to revive demand. Profit, profit maximization. Larger loan books generate higher interest income. Financial inclusion. Expanding credit brings unbanked sectors into the system. Competitive necessity. Slow growth may lead to loss of relevance. Improvements in favor of credit quality, capital preservation, poor quality loans erode net worth, regulatory compliance, RBI norms on asset quality are stringent, reputation risk, high NPH damage credibility, long-term profitability, sustainable returns depend on recoverable assets, systemic stability, asset quality issues can trigger financial crisis, regulatory perspective, RBI stand. The Reserve Bank of India emphasizes responsible lending over reckless expansion. Key regulatory measures include risk-based supervision, asset classification and provisioning norms, prompt corrective action (PCA) framework, stress testing and ICAAP, enhanced disclosure requirements, expected credit loss framework aligned with global standards. RBI consistently advises banks to focus on quality adjusted credit growth, not headline numbers. Role of risk management in balancing both. An effective risk management framework is central to balancing growth and quality. Key tools: credit scoring and rating models, sectoral exposure limits, risk based pricing, portfolio diversification, stress testing and scenario analysis, early warning systems, SMA 0, 1, 2 monitoring. Risk management should act as a business enabler, not a business stopper. Technology and data analytics as enablers. Modern banking leverages technology to achieve both growth and quality. Key contributions: AI-based credit underwriting, alternative data for MSME and retail loans, digital loan monitoring, real-time alerts on stress signals, better fraud detection. Data-driven lending allows banks to expand credit responsibly. Sector-specific strategies. Retail lending, granular, diversified, relatively stable, supports growth with manageable risk. MSME lending, high growth potential but requires close monitoring and handholding. Corporate lending, high ticket size, demands stringent appraisal and consortium discipline. Agricultural lending, social obligations with risk mitigation through insurance and government support. Balanced sectoral allocation is crucial. Good disbursement monitoring, the missing link. Many asset quality issues arise not at appraisal but after disbursement. Best practices: regular stock and book debt audits, site visits and inspections, monitoring end use of funds, periodic review of financial statements, close tracking of account conduct. Strong monitoring converts growth into quality assets. Of recovery and resolution. Even with best practices, stress is inevitable. Effective recovery mechanisms help protect credit quality. Timely restructuring under regulatory frameworks. Use of SURFACE and IVC. Settlement and compromise schemes. Dedicated recovery verticals. Data-driven follow-up. Recovery is as important as sanctioning. Cultural aspect. Tone from the top. Senior management plays a critical role by promoting ethical lending, avoiding target-driven mis-selling, encouraging prudent risk-taking, aligning incentives with asset quality, building a risk-aware organizational culture. A strong credit culture ensures sustainable gains. Way forward, achieving the right balance. The optimal approach lies in responsible credit growth. Key strategies: growth aligned with risk appetite, quality adjusted performance metrics, strong governance and accountability, technology led credit decisions, continuous skill upgradation of credit officers, focus on long term value rather than short term growth targets. Banks must shift from volume driven to value driven lending. Conclusion: Credit growth and credit quality are not mutually exclusive but complementary objectives. Excessive focus on growth without quality leads to NPH, while excessive conservatism stifles economic progress. The real success of a bank lies in achieving sustainable credit expansion supported by robust risk management, sound governance, and proactive monitoring. In the evolving banking landscape, the institutions that master this balance will emerge as resilient, profitable, and trusted pillars of the financial system. Thank you very much for your patience. Request for like, subscribe, and share